That's one of the biggest misconceptions. Once you get into the game of real estate, you're adding complexity. Our top clients, they're using before you eventually go to jail.
Taxes are one of the most misunderstood topics in real estate. Aside from the threat of jail time, the consequences of not understanding your taxes are too severe to ignore, which is why we sat down with Thomas Castelli, one of the leading experts on taxes in the real estate investing community. If you've ever wondered, what do most people get wrong about taxes? How do the rich pay $0 in taxes? What is the real estate professional status, and do I qualify? Keep listening. And towards the end, Thomas shares the secret pattern that sets top performing investors apart from the rest. You can't afford to miss this. Your story is so unique because a lot of times people will go from their career that's outside of real estate into being on the active side. And it seems like
Right.
you were involved on the active side really early on, especially syndication. It's such a specific, almost high level side of real estate. So that's so cool that you transitioned to the tax side of things. And that's kind of what the topic that I wanted to dive into today. Um, I've heard horror stories growing up, but also recently involving celebrities and taxes. And I just want to name a few because I think they're kind of funny. But Todd Chrisley, the Jersey Shore's The Situation, and Martha Stewart have all went to jail for taxes. And overall, a lot of people have this fear that if they mess up on their taxes, that means that they're going to go to jail. So to start off this conversation, I'd love to know what are some common misconceptions or misunderstanding that people get wrong about taxes, maybe even from specifically the investor perspective.
Right. Okay, so the first thing I'll say is that it takes a while before you're going to go to jail for taxes. Okay, so everybody can calm down. You're typically going to get audited. They'll typically garnish your wages and like put you on a payment plan, all this fun stuff before you eventually go to jail. So you have a good runway. Um, so that's one misconception. The IRS isn't going to just automatically send you to jail. But from an investor standpoint, one of the biggest misconceptions that I hear from real estate investors is that you can take losses from your rental properties and use it to offset, your active, maybe income from a job or a trade or business you might be running. And that's not necessarily true. It starts off as passive. There are ways to make it non-passive, and I'm sure we'll talk about that today. But that's just one of the misconceptions, right? There's certain rules you have to follow if you want to use the losses from your rental properties against your other forms of income. So that's probably the biggest misconception we see. Another misconception is that just basically another misconception is that that if you file your tax return, if you file an extension for your tax return, right? So tax returns for individuals typically going to be due April 15th, right? Now you can extend your tax return until October 15th, right? Now the misconception is that if you file that extension, you're filing late. You're not filing late. You're filing an extension, perfectly legal. You're not going to jail for filing an extension. So that's just another misconception that we commonly come across. I mean, there's a lot of them, but those are probably the two biggest misconceptions that come to mind directly right now.
Yeah, it's so funny. We had our K1s going out and they were going to be late, and so we had some investors upset.
Yeah, well, you know what it is when you get into the game of real estate, right? I'll back up for a second. Like if you've been used to, if you just have a job and you're used to filing your taxes, maybe you're using TurboTax, or maybe you go sit down with your CPA, at some point in the first quarter of the year. Your situation might be relatively simple, but once you get into the game of real estate, you're adding complexity, and especially if you're investing in partnerships, partnership taxation is a whole another level of complexity that you're adding to the situation. So if you're going to be investing in real estate, I'm going to say in general, you should expect to extend your tax return as an expectation, as a general rule.
Yeah, and to kind of build off of that, another perspective I know is held mainly maybe not by investors but other people outside of the investment world is that the rich don't pay taxes and they're not paying their fair share of taxes, or they're doing something kind of illegal if they're
Right.
not paying taxes. Can you address that, but also explain? And I know this is a whole topic we could discuss, but just provide an overview of how people, investors out there, are actually paying $0 in taxes when they are making a lot of money.
Yeah, so there's a few different tools they're using. I'm gonna go with the first tool. I think everybody who invests in real estate could effectively take advantage of this. It's called Buy, Borrow, Die is the name of it. There's other names, but that's the most common name. And basically, what happens is you'll buy assets. Say you'll buy real estate, or maybe you own a business and you have stock in the business, right? Or you own a lot of publicly traded assets. Over time, these assets will appreciate in value. And when you sell these, if you were to go ahead and sell these assets, you're going to be paying taxes, right? You're going to be paying capital gains taxes up to a rate of 20% plus the net investment income tax in certain situations. So you might be paying 23.8% when you sell those assets. So what the rich do is rather than sell those assets, they go get a loan against the asset and they use the asset as collateral. So, for example, real estate works really well with real estate, right? You go and get, some people might know it as a home equity line of credit, but basically, if you have rental properties, it's just a line of credit where your rental property is the collateral for it. And banks love real estate as collateral, as we all know. And you could also do a cash out refinance. So when you do a cash out refinance or you get a HELOC, those loan proceeds are not taxable. So you could take the loan proceeds from the HELOC, from the cash out refinance, and you could go use it to reinvest and build your portfolio, or you can go buy personal items for it. Just to kind of give an example of buy, borrow, die. Elon Musk, right? So he has a lot of Tesla stock, right? And rather than selling his Tesla stock, he went ahead and he got a loan against his Tesla stock, and he used it to acquire Twitter. That's part of the way he acquired Twitter was, if he would have sold his Tesla stock, he would have paid capital gains tax, and B, he would have lost the shares of that company, right? And the future growth that that company could potentially have. And instead, when you go get a loan against them, you're able to tap into that equity tax free. So that's one tool that the rich use to pay no taxes. Is instead of selling their assets, they collateralize their assets and use loans, take the loans and go ahead and build their wealth. That's how they do it. Another way they do it is using something called the real estate professional status, especially if you're in real estate. So, kind of, long story short, what the real estate professional status allows you to do is allows you to take losses from your rental properties. So, let me back this up a little bit more first. Let me give this context, right? So, when you invest in rental real estate, it's one of the most tax advantage asset classes out there. And the reason for that is an expense called depreciation. So, depreciation is a non-cash expense that reduces your taxable income on paper, despite the fact that you might have actually generated positive cash flow. So let me just give a quick example. Let's just say you had a rental property that generated $10,000 in income, and then you had, let's just call it $5,000 in real tangible expenses. I'm talking about maybe it's utilities, property management fees, legal fees, um, property taxes, repairs, maintenance, all that good stuff, right? That total $5,000. Well, now you're going to have $5,000 in net income, right? In most other businesses, you're going to end up paying taxes on that $5,000 in net income. But with real estate, we now have this non-cash depreciation expense. And let's just say, for the sake of this conversation, the depreciation expense was $6,000, which is very common. If not, you could get a lot more than that. But let's just say $6,000. Well, now all of a sudden you have a loss for tax purposes of $1,000, right? So you had $10,000 of rental income, $5,000 of like tangible expenses you had to pay somebody else. That money left your bank account. You were left now with $5,000 in quote unquote cash flow that's sheltered by this depreciation expense, now causing you to have a tax loss of $1,000. So you just made rental, you just made cash flow, you just made income, if you will, without paying taxes on it. So that's one step of the equation. The other step of the equation is that if you can qualify as a real estate professional, which basically means you're working full time in real estate. We can get into the requirements, but you could take the rental losses, that $1,000 loss in this example here, and use it to offset the income you might be generating, or your spouse might be generating if you're married filing joint, from an active trader business or perhaps a job that you might hold. So that's another tool that specifically real estate investors use to pay little to no taxes, and we see that happen all the time. There's plenty of real estate professionals out there who are paying little to no taxes. So
No, that's awesome. I appreciate you breaking that down. There's a lot of points there that I want to dive into, but first, taxes is in general a topic I think that can be scary, intimidating, and overwhelming for a lot of people. So I want to attempt to break it down from this like bird's eye view, and then we'll dive into the intricacies of certain facets of the topic of taxes. But to start out, you mentioned there's different kinds of income, income you get from your rental property, income that you make from your W-2 job. Can you clarify the different kinds of income? Because I think a lot of people understand because they pay taxes on the income they make from their job. But can you provide some definitions and context for the different kinds of income and the tax implications for each one?
Okay, yeah. So there's a few different buckets. Okay, I'll break it down like this. So there's going to be earned income, right? Earned income is income from a job or a business that you're actively involved in. A good example of a business that you might be actively involved in is maybe fix and flipping properties. Maybe you do consulting. Maybe you have a medical practice. Maybe you own a pizzeria. Whatever the case is, these are typically businesses that you're actively involved in. This earned income is taxed at ordinary tax rates, anywhere between 0 to 37%. So that's kind of the first bucket, earned income. You're also going to typically be charged FICA taxes. If you have a job, you're going to pay Social Security, Medicare. You're going to pay half, 7.65%. Your employer is going to pay half, 7.65%. If you're self-employed, you get the luxury of paying the entire amount, it's 15.3%. So that's the earned income bucket. Very difficult to shelter earned income unless you're a real estate professional or use like the short-term rental loophole, which again I'm sure we'll talk about. But that's the first bucket. The second bucket is going to be we're going to go. Second bucket is going to be portfolio income. So portfolio income is typically going to be income that you're going to earn from, say, stocks, bonds, mutual funds, things like that. Now, capital gains are typically taxed at rates between 15 and 20%, and they could also be subject to what's known as the net investment income tax, which is an additional 3.8% under certain circumstances. So that's kind of the portfolio income bucket. Now, I just want to note that qualified dividends, so dividends for stocks you held for like more than a year, are going to be in that bucket. But otherwise, dividends and interests are taxed at ordinary income rates as well. Same way as kind of earned income. But that's portfolio income. Now you're going to have another bucket. It's called passive income. Now, passive income is different than portfolio income, and I think a lot of people get confused with this because people sometimes say, "Well, I invested in a stock, right?" Say maybe you invest in Tesla, and Tesla shoots up in value. Well, you didn't do anything but just click a few buttons on the mouse probably to buy that stock. So you might be saying, "Oh, that should be passive income." Well, unfortunately, it's not. It's portfolio income. That's just kind of the way the tax code works. Then you have passive income. Passive income is generated from rental activities. So all rental activities are passive by default. So they're just in that passive bucket. There would also be in that passive bucket is income from businesses in which you do not materially participate. The most common would be if you're a limited partner or the money partner, if you will, on an active trader business. So, for example, you can own a pizzeria, but if you just have a percentage interest in the pizzeria, someone else is operating it, and you just put the money up, that could potentially be a passive activity for you. Passive activities, the income from passive activities are typically going to be taxed at ordinary income tax rates up to 37%. However, the losses from passive activities, they can only offset income or capital gains from other passive activities. They typically cannot offset other forms of income, such as earned income or portfolio income. So that's kind of the three buckets and kind of how each of those buckets works in a nutshell.
That reminds me of, so I was listening to your podcast, and I know there's an episode titled "The Difference Between a Passive Loss and Net Operating Loss," and I think this would be a good time to maybe break that down a little bit. Can you explain what a passive loss is and how it's different from that net operating loss? And I don't know if I figured that this would connect to the idea of the passive activity loss rules.
Yep.
How are these at play in this context?
Yeah. So the passive activity rules is what's known as Section 469. It just says that all passive it's basically in a nutshell, it says that rental activities are passive by default. Businesses can either be passive or non-passive, depending on whether or not how heavily you're involved. And the losses from passive activities can only offset income from passive activities. So that's kind of the passive activity rules. Now, when it comes to a passive loss versus a net operating loss, a passive loss is going to be a loss generated by a passive activity. So, for example, rental property or business that maybe you're not involved in. That's what's going to generate the passive loss. Whereas a net operating loss is going to be generated from a business in which you are materially participating in. To give an example, I'm going to use a pizzeria as an example. So let's just say that you have two partners, they own a pizzeria. Partner A is the general partner. They're making the pizza, they're running the pizzeria. And partner B just invested the money to get the pizzeria started. Partner B doesn't really do much. Now, let's say the first year they're in operations, just for the sake of argument, that they have a loss on that pizzeria. So for the partner A, that loss is going to be a net operate. It's going to be a net operating loss effectively for partner A, and for partner B, that's going to be a passive loss. So kind of the difference between a net operating loss and a passive loss is the bit for the most part, is going to be if the business is active for passive. So to give another example of this, let's say you have a rental property, right? And let's just say that rental property generates a loss for the year. Well, if you're not a real estate professional, that's going to be a passive loss. If you are a real estate professional, that loss is going to be considered a net operating loss effectively. And the way net operating losses work, is that when a net operating loss is carried forward, they're typically not going to be passive going forward. So they can offset passive income in the future years, whereas passive losses, if you cannot use all your passive losses in one year, they're going to be suspended and carried forward as a passive loss, meaning they can only typically offset only passive income in the future. So does that kind of break it down?
No, yeah, that's awesome, and I appreciate that. And so, just to recap, I think overall we just discussed the different income buckets. So there's the passive, the portfolio, and the earned income. Is that right?
Right.
Okay. And so you kept touching on that real estate professional status, and you did define what it is. I think it would be helpful if you could expand on the qualifications. And it seems like the difference in my understanding, so you can correct me, but it's the level of active or versus passive involvement a person has in that investment. So I guess my question is also to build off that: can someone with a W-2 still qualify as a real estate professional, and what are the other qualifications that go into that status?
Yeah, that's a great question. So, under Section 469, and I'm gonna break it down like this. So, under Section 469, all rental activities are passive by default. So, what does that mean? It means doesn't matter how active or not you're involved in your rental property, it's going to be passive, unless you're a real estate professional, which we'll get into that. Or businesses can also be passive, depending on your level of involvement. For businesses, there's a lot lower of a threshold. To be active in a business, you just have to meet one of 7 material participation tests, which could be as little as doing everything yourself or spending more than 100 hours and no one else spends more time than you. Like, that's just a quick example of how easy it can be to turn a business non-passive, right? Whereas with real estate, in order to turn the rental real estate non-passive, you have to be a real estate professional. Now, to qualify as a real estate professional, you need to spend more than 750 hours in a real property trade or business that you materially participate in. And you must spend more than half of your total working time in real property trades or businesses. So it's a two-pronged test. The first is you must have more than 750 hours. The second is it must be more than half of your total working time. Now, there are 11 real property trades or businesses. I'm not going to go through all of them here, but basically it's brokerage. If you like a real estate agent or you're a broker, maybe you're fixing and flipping properties, you're in construction, you're a developer. Those are typically going to be property management. Those are typically going to be real property trades or businesses. Now, if you materially participate in one of these real property trades or businesses and you meet the real estate professional status, that's great, right? So, for example, if you're a real estate agent and you spend more than 750 hours and more than half your total working time working as an agent for the year, you'll be a real estate professional. Now, something is important to note is that if you're in a real property trader business full time that's not a rental business, you still must prove that you materially participated in your rental properties, even though you might be a real estate professional. So you might be that agent as a full-time agent and you qualify, but you still have to meet one of the material participation tests on your rental activities to turn them non-passive. However, if your only real property trader business is rental activities and you met the real estate professional requirements, then you've already met the material participation test on the way to qualifying as a real estate professional. The last part of your question you asked about can you qualify if you have a W-2 job? Well, typically not. In fact, it's been proven virtually impossible to qualify. And that's because the IRS looks at a full-time job as 2,080 hours. So that's about 40 hours a week for the entire year. Whereas they look at, so remember, you spend more than half your total working time in a real property trader business. So in order to spend more than half your total working time, if you're working 2,080 hours a year or considered to be working 2,080 hours per year by the IRS, that means you would need to spend 2,081 hours in a real property trader business. So that means you're working 81 hours per week for the entire year, which is, virtually impossible. There's been dozens and dozens of tax court cases on this, and only one person who had a full-time W-2 job was able to qualify, and they were a pilot, and they were able to prove that they spent only 1,000 hours being a pilot for the year, and the rest of the time was spent on real estate. But outside of that, like if you have a W-2 job, chances are you're not going to qualify. I'll say one more thing along this line. There is a strategy around that, a way around that. And that's if your spouse can qualify. So if you're married, you file a joint return, and let's say that spouse A has a full-time job, maybe they're a doctor, just for example, and then spouse B works full-time in real estate. Maybe they're a real estate agent, they manage the rental properties. The losses from those rental properties can offset, if spouse B is the real estate professional, can offset spouses A's income. So basically, long story short, if one spouse qualifies as a real estate professional, then it kind of counts as both spouses qualifying for the purposes of what we're talking about here.
No, I appreciate that, because I think there is that misconception where a lot of passive investors think, and maybe this will formulate into a question, but a lot of them believe that by investing they get to write off their earned income, when I am imagining now that that isn't necessarily the case, at least not directly.
Right, right. So yeah, there's a lot of that's one of the biggest misconceptions, right? Like, if you invest in real estate, you could take the losses and write off your earned income. That's just simply not the case. The only way to make that really possible is going to be real estate professional status, and then there's a special carve out for short-term rentals
Yes.
that you can do with short-term rentals. But
Yeah.
typically speaking, yeah, you're not going to be able to do that unless you meet one of those two criteria.
Yeah, and I'm glad you brought that up, because I was going to kind of pivot into that topic. I had a guest come on a few days ago on the show, and she was discussing the short term rental strategy. It's becoming more popular, but I think you've been a vocal advocate for this quote unquote loophole, whether you want to call it that or not. But can you expand on what that is, and maybe what the qualifications are for that, and if it's even worth doing?
Right, right. So at this point, I probably said, I don't want to sound like a broken record, but I probably said a bunch of times that rental activities are passive by default. Well, there's a carve out in the regulations that identifies exceptions to the definition of rental activities, and there's, I think, 6 or 7 of them. But the two most relevant ones for short-term rentals are going to be if the property has an average stay of 7 days or less. So if the property has an average stay of 7 days or less, it will not be considered a rental activity. If it has an average stay of 30 days or less, and substantial services, which are hotel-like services, are provided to your guests. Now, these rules were put in place for hotels, right? Like, it's the reason why they call it a loophole is because these laws were written in the 80s, and in the 80s, no one foresaw Airbnb coming along and being as popular as it was, and giving the everyday investor, if you will, the opportunity to rent out a single-family home, for example, for 7 days or less. It just wasn't practical. But now, the way people are looking at it's a way around the rules. That's why they call it a loophole. So let's just say, for example, you have an average stay of 7 days or less on your rental property. Well, now it's not a rental activity; it's a regular business. And now all you have to do, you don't have to qualify as a real estate professional to turn the losses non-passive. All you have to do is materially participate. Now, there are 7 different material participation tests that are in the regulations, but 3 of them are going to be most relevant to most investors. And that's going to be, you spend more than 500 hours on the activity for the year. So it means you spend more than 500 hours managing your short-term rental. That one, admittedly, is the most challenging for most short-term rentals, at least in my experience, short-term rental owners to actually achieve, because there's just not often 500 hours of time to spend. But another one is you do substantially everything yourself. So that pretty much means you're a one-person show and you manage the property. You do pretty much everything. The other one is you spend more than 100 hours managing the short-term rental, and no one else spends more time than you. So basically, that's the most popular test for the short-term rental loophole, because it allows you to self-manage your properties, handle the bookings, handle the coordination between the cleaners, any repair crews, the setup of the property, all that good stuff, and still get help from other people. So that's the most popular test. So if you meet one of the exceptions to the definition of rental activity, and you materially participate, meeting one of those tests I just mentioned, then the losses from your short-term rental, specifically the short-term rental, will be non-passive. Okay, so that would mean that the losses from the short-term rental can be used to offset the W-2 and active trader business income. But I just want to be clear, it's just the short-term rental. Using what I just mentioned won't turn the losses from your long-term rentals non-passive. I get that question all the time, and it's just the short-term rental.
Yeah, no, thanks for clarifying that. And I mean, the real estate professional status and the short-term rental loopholes, those both sound like really great strategies. And I'm sure, like you're saying, a lot of investors do take advantage of them. But it's evident that not everybody can take advantage of it. And in the past, I've heard you say that when someone's investing in real estate, they're looking to reduce their effective tax rate. And so my question would be: is real estate? And I think I know the answer, but what is your perspective on the question? Is real estate still a good investment if somebody doesn't qualify for either of those two? And if so, how are they able to still reduce their effective tax rate?
Right, right. So yeah, let me break it down like this. So the short answer is yes, it could still be very valuable even if you cannot use these strategies. And that's because it can help you reduce your effective tax rate. So your effective tax rate is the amount of income that you're generating, um, the amount of tax you're paying divided by the amount of income that you're generating. So what real estate allows you to do, kind of taking it back to full circle to where we kind of started, when you buy a piece of rental real estate, the depreciation shelters that cash flow from tax, right? So you could generate, let's just say you generate $5,000 of income from rental real estate, just to use a number. Well, but you didn't pay tax on it. Well, you can add that to your income, right? So now let's put it to, let's just I'm just going to use an example for the sake of illustration. So let's just say that you're paying $30,000 in tax, and you were earning, let's just say you're earning $100,000 in income, just for the sake of this conversation. Well, your effective tax rate in that situation would be 30%. But now let's just say that you're earning the same $100,000, but then you earned, or you generated rather, $5,000 in cash flow from your rental properties that you didn't pay tax on. Well, now let's just say that, well, now in that case your income boosts to 105,000. Well, now you're paying the same $30,000 in taxes, and now you're dividing that by 105,000, right? Because you increase your income, and now your tax rate's only 28.5%. But now let's just say the next year you buy some more rentals, and now you're earning $15,000 of rental income. Let's just assume you're still paying the same $30,000. Well, now you have $115,000 of income, and you're only paying $30,000 in taxes. So that would make your effective tax rate 26%. So the way rental income helps you decrease your effective tax rate rather, excuse me, is by basically you're generating tax-free income, and you're still paying the same amount of taxes you're paying before. So the more tax-free income you can generate from rental properties, the lower your effective tax rate is going to be over time. And I think that's it's sorry. I was gonna say, I think it's just something that a lot of people overlook when it comes to rental activities. They see that, oh, I can't get this big tax break through the real estate professional status for short-term rentals, and then they ignore the fact that they're generating tax-free cash flow from their rental properties, which is reducing their effective tax.
Absolutely. I think a lot of people, that's their main objective, right? And I know a lot of people get into this real estate investing space to simply reduce their taxes. And so it's so important. And we're going to touch on maybe some other misconceptions later on. But you mentioned depreciation earlier, and I think depreciation has been a hot topic recently, especially towards the beginning of this year, because it was the 100% bonus depreciation started to be phased out, and with I believe only 80% bonus deduction starting this year, and then it's going to be less moving forward. So I wanted you to first off maybe explain what depreciation. You think you already touched on what depreciation is, but if you have anything to add to that, why it's also considered a phantom expense, and then can you maybe touch on the ramifications of the depreciation change and what it means for investors moving forward? Do you think depreciation benefits is this the end of depreciation benefits in real estate?
It's absolutely not the end, but to break it down, depreciation, basically when you buy a rental property, right, you're buying a pretty sizable asset. Let's just say you're buying it for $500,000, right? Well, you're not going to, with a normal expense, you're just deducting that expense in the first years, right? So if you buy if you put a repair on a property for $500, you're going to deduct that repair in that year. Well, because the rental property lasts longer than a year, you're going to depreciate that property over multiple years. So the depreciation expense is non-cash because each year you're taking the depreciation expense. It's not actually taking money out of your pocket. It's just the expense on paper, recovering the cost of the asset that you already acquired. So a typical long-term rental property is going to be depreciated over 27 and a half years. Now, there's something called bonus depreciation that was introduced within the tax code. And bonus depreciation, it was at 100% between September 27th, 2017, excuse me. I don't know why they chose the September 27th, but they chose that date through no, December 31st, 2022. Now it's 2023. It drops down 20%. Now it's only at 80%. Well, that just what 100% bonus depreciation allowed you to do was, let's just go back to this example. You had a $500,000 property, right? Say you have a $500,000 property. Land is never depreciated, so a certain portion of the land is going to have to be allocated to that $500,000. Let's just say it's 20%. So that would mean that the building, the actual property, the actual house, is going to be depreciated over 27 and a half years. And it's $400,000 because we backed out $100,000 for the land. Well, normally, if that's going to be depreciated over 27 and a half years, you're gonna get a depreciation expense of $14,545 per year. But there's something called the cost segregation study. And what the cost segregation study does is it breaks down the components of that property into shorter class lives. Because when you're looking at a house, there's more than just the walls and the structural components. You have carpeting, you might have appliances, you have all these different components of the property. Well, a cost segregation study is going to break down that property into its various components. Now, typically, you're going to have 5-year property, which is tangible personal property under the tax code. That's going to be things like the carpeting, the appliances, things like that. Then you're going to have 15-year property, which is land improvements. That's going to be things like decks, pools, sheds, things of that nature, fences. And somewhere between, depending on the property, somewhere between 20 to 30% of that building is going to be eligible for bonus depreciation, or it's going to fall under, it's going to fall under a property with a class life of less than 20 years. So that 5-year and that 15-year bucket. Sometimes there's 7-year property. That's just kind of property that doesn't fall into another class life. They'll just put it into 7-year. We rarely see that on real estate, but it exists. So let's just say that you have this $400,000 property, and we'll be conservative. Let's say that 20% can be reallocated to this 5 and 15-year property. Well, that 5 and 15-year property is under 20 years, right? And the property with class life of under 20 years, that's going to be eligible for bonus depreciation. So in 2022, from that September date in 2017 through 2022, you'd be able to deduct the entire $80,000, right? Because you had a $400,000 property. We're assuming 20% is being reallocated to property with a class life of less than 20 years, and that $80,000 is eligible for bonus depreciation. Well, with 100% bonus depreciation, you're deducting that full $80,000 deduction all in the first year. Now, with only 80%, you're only getting $64,000 deduction in this year in 2023, and this is going to phase out 20% each year until 2026 when it's gone. So in 2024, you only get 60%. So to answer your question, is the end of depreciation? No. Bonus depreciation is still going to be quite powerful this year in 2023, as well as 2024 and 2025 too. It's still going to be pretty powerful at 40%. But as it phases down, it's just going to become less powerful. It's not going away, and it's certainly not the end.
Yeah, that's a big relief. I love that, man. And I know at the Real Estate CPA, you guys have this saying, don't let the tax tail wave the dog. And I've heard that in other contexts, but I thought that was really awesome the way you guys put it. Can you explain what this means and how an investor can apply that idea to their own approach to investing?
Yeah, absolutely. So, as you kind of mentioned before, a lot of people get into the real estate space to reduce taxes, right? And with that, people will make decisions, investment decisions, sometimes entirely based on the tax benefits, or in other cases, they'll overweight their decision based on the taxes. So don't let the tax tail wag the dog, wave the dog. It means basically, when you're making an investment decision, put the investment decision first. Does the investment make sense for your overall investment strategy? Does the investment make sense from an investment perspective? Will you make money on it? Does it meet your return criteria, right? Or are you going to lose money? And to kind of go a little bit deeper on that, for example, a perfect example of letting the tax tail wag the dog is if you don't have the time to manage properties, right? Then maybe the short-term rental loophole is not for you, right? If you don't want to be in the short-term rental business, you don't want to be in the hospitality business, then the short-term rental loophole is not for you. Don't go into that strategy if that's your in that case, because you might all of a sudden have the short-term rental property that you just bought for the tax benefits, and you may be and you may not want to manage it. So now all of a sudden the property is not operating properly. It's not cash flow positive. You're losing money now. So now you're actually losing money, right? So that's one example. Another example would be some people just want to get the tax benefits so bad they'll buy a property that doesn't make investment sense at all. They'll buy a property that they can't cash flow on, or they're going to be losing money, losing real money on, just to get the tax savings like at the end of the year. So that's kind of what don't let the tax tail wag the dog means, is just look at each investment decision for what it is. Does this make sense in the long term for me? And does this actual investment make sense? Don't make these decisions purely on the tax benefits, and don't overweight the tax benefits.
Absolutely. Yeah. I mean, I know we've said this a lot, but that's a big incentive and motivating factor for people is taxes and reducing their taxes. It's why they invest in real estate. And you see syndicators and capital raisers left and right advertising the tax benefits. I mean, I'll be candid. It's on our website. It's one of the main benefits. And so in the past, you've kind of alluded to this notion that it can be true, of course, that there are tax benefits to investing in specifically multifamily syndications, but it can also be somewhat misleading, or people can have
Right.
misinterpret what that means. So how are investors potentially being misled for these when they passively invest in these real estate deals?
Right. So when you invest passively in, say, real estate syndication, you're typically going to get a loss passed through to you on the Form K1, especially in the first year you're investing. And that's thanks to bonus depreciation effectively. Now, what happens to that loss? Well, as a passive investor in these deals, that's going to be a passive loss for you. So that means that loss can only offset income or capital gains from other passive activities. That could be another syndication, maybe you're investing in. It could be the same syndication later on down the line. To give an example, if say you invest in two syndications, right? Syndication A throws off a loss this year of, let's call it $20,000. But then you had invested in syndication B, let's say 3 years ago, right? Now all of a sudden syndication B is going to be sold this year and you're going to have a capital gain of $80,000. Well, that capital gain can be offset by the $20,000 of losses from the syndication this year. Where I think people are misled is by the fact that some people think, oh, if I invest in the syndication, I can take that $20,000 loss from syndication A and use it to offset my W-2 or active trader business income. And that's just not the case. When you're investing as a limited partner, it's going to be passive. And that just means that the losses can only offset other passive income. Now, there is an exception to this, very narrow exception. And that's if you qualify as a real estate professional, you have your own portfolio. You meet the 500-hour material participation test. So in other words, you qualify as a real estate professional and you're spending a minimum of 500 hours on your own rental portfolio. Well, then you can group your limited partnership interests in with your active portfolio, and those losses from the limited partner investments will be non-passive. But that's the limited time that it can happen. But if you're purely a passive investor like me, for example, I have a full-time job effectively at the CPA firm. If I invest into a syndicate, those losses are going to be passive for me all day, and that's just the way the cookie crumbles.
This conversation has been just extremely insightful. To bring it full circle, you mentioned you work at a CPA firm, and I imagine you're working with extremely wealthy and successful real estate investors. So I'd love to know, are there any common habits or patterns that you see regarding taxes or just investing in general among your top performing investors, clients?
Our top clients, they're using real estate. They're using buy, borrow, die, and combining it with 1031 exchanges. And so what I mean by that is they're buying properties and they're only what they're either holding them forever, and when they need money to get money out, they're using a HELOC, or they're using a line of credit or a cash out refinance to pull money out. They're not selling the property. And when they are selling the property, for whatever reason they may need to sell the property for, they're using a 1031 exchange to defer the taxes on the sale of that property, and basically buy another property. And they're using the 1031 exchange over and over and over again. So yeah, our top clients, they just buy real estate. They use the buy, borrow, die strategy. And when they do have to sell, they just do 1031 exchange, and they keep doing that over and over and over again. And then what happens is, you'll find is that they have these very big portfolios over the case of decades, sometimes portfolios that are valued in the billions of dollars, quite literally. And then what happens is, when they pass away, they're structured in such a way to basically pass those assets down to their heirs in a very tax efficient manner. And they're paying little to no taxes. So I would say that that's the common thread among our top clients, is they're buying and holding for the long term. And that's kind of the key. That's kind of the key to building a long-term wealth in real estate. Yeah, so there's two places I would say. The first is going to be the realestatecpa.com. So we have a blog, we have podcasts on there. If you want to check any of that out, just head over there, realestatecpa.com. We also have a Facebook group, Tax Smart Investors. You could find it by going to facebook.com/group/Tax Smart Investors. You could find us there. A lot of people ask questions in there. It could be a great resource, but those are probably the best ways to find us. And of course, we also have a podcast, Tax Smart REI podcast, but those are the common ways.